Theresa Hoffman. She's a partner of the Beecher, Walker, Morris, Hoffman, and Johnson law firm, and a founding member of the Waterloo Community Foundation. And she has graciously agreed to talk to us about a very important topic at this time of the year, and is regarding donors and organizations alike as we anticipate year-end giving. And I want her to share her expertise because she has a lot of valuable information, and I know she has a lot of information to disseminate. So what I'm going to do is make my presentation brief. And once again, welcome. And Theresa, thank you. I'm going to turn it over to Theresa.
Okay, we're going to talk about charitable giving today. And some of you are individual donors. Some of you represent organizations to which somebody would be giving monies to them. I'm going to talk about this from the donor's perspective so that if somebody has charitable intent, what we want to do when we meet with them is determine what is the best way for them to give. When do they want to give? Is it during lifetime or is it upon death? What's the best assets to use to culminate in that charitable giving? So the first step is the person has to have charitable intent. They have to want to give to a charity either during lifetime or upon death. So when we're meeting from an estate planning perspective, we start with having them put together a list of all of their assets. We want them meeting with their accountants, their financial advisors, their attorneys to determine what is the best way to achieve that gift. So once they've determined that they want to give to charity, we start looking at the assets that they have. How much they want to give plays into this, but many times when we're able to achieve a tax advantage, whether it's in current income tax savings or estate or inheritance tax savings, the gift can be larger. People don't always understand what benefits there are from charitable giving. So when we start looking at assets, one of the most attractive assets for giving are retirement plan assets. Individuals may have an IRA, a 401k plan, annuities, or a pension. We want to take a look at those to provide us with an opportunity for gifting. For IRAs, those are the easiest and the most attractive vehicles to give from. With an IRA, if you're over age 70 and a half, you can do a charitable rollover, which means you can have monies from your IRA go directly to a charity. That limit is up to $100,000, anywhere from $1 to $100,000 you can have go directly to that charity. By doing a charitable gift rollover, you don't even claim that then on your income tax return. So you eliminate all the taxation. Normally, when monies are coming out of a retirement plan, you have to claim those as ordinary income. But if it goes direct from the IRA to the charity, you don't claim any of that income on there at all. You don't get the deduction either, but it's not being included in your income for you. And if you do that, you're still available for some of the credits that we're going to talk about later, the Endow Iowa credits, the STO credits. So it's a great way of giving. It's also very beneficial for those individuals that are no longer itemizing on their deductions on their tax return. And that's because the standard deduction has increased so much that many people are no longer itemizing. So if they're over age 70 and a half, this is a great way for them to get that tax advantage. If you have monies that are in an annuity, deferred annuity is an asset that for example, you contributed $10,000 to it. It's grown to $15,000 because the income on it has been deferred. If you want to gift that annuity to a charity, you still have to claim that $5,000 of deferred income, but you get a charitable deduction for the entire $15,000 that you are then gifting. So it's another great asset to provide you with an opportunity for charitable gifting. We also then look at appreciated assets. Appreciated asset is an asset that has grown in value from what you originally either purchased it for or inherited it for. When you purchase an asset, that's your basis. When you sell it, hopefully for a higher amount, you're going to have capital gains tax that would attach to that gain. So you'd have to pay capital gains tax on your income tax return. If instead you gave that asset to a charity and the charity sells it, there is no longer any capital gains tax. So you've eliminated all of that tax. In addition, you get a charitable deduction for the fair market value of that asset. So you get to deduct the entire amount. You've eliminated the capital gains tax on that. So appreciated assets are another good asset for giving, especially if that asset has not been providing you with much current income and you want income from that asset, but then paying the capital gains tax would reduce significantly what you had as far as a value to convert into an income generating asset. So when we're looking at gifting, those two assets are very good choices: retirement plan assets and appreciated assets. Cash, of course, is always good, but we're always looking at ways to get more tax advantage if we can. So those assets are good for lifetime giving. Testamentary giving is giving that happens when you're gone. So a lot of individuals have the ability to give during lifetime. Some say, well, I'm just not comfortable giving up those assets now. I would rather do it upon my passing. You can do that then through your will, through a revocable trust, through a beneficiary designation on your retirement plans, a transfer on death designation. There's lots of ways of doing that. You don't get any current income tax deduction for doing that, but it is a deduction against your federal estate tax or your Iowa inheritance tax if there's any. Federal estate tax, I'd sure like to tell you what that's going to be coming up, but we don't know because Congress can't really seem to get on the same page with that. But currently the exemption is $11.7 million per individual, scheduled to go up to roughly $12 million as of the first of the year, potentially being cut in half depending upon what they do with the tax legislation that's in front of Congress right now. Iowa inheritance tax. There's no Iowa inheritance tax on spouses, children, stepchildren, grandchildren, descendants of stepchildren. There still is Iowa inheritance tax on what we refer to as collateral relatives, brothers, sisters, nieces, nephews, and non-relatives. That tax is going to go away gradually over the next 4 to 5 years, though. But if you do give to charity, there is no estate tax. There's no Iowa inheritance tax on that. When we're looking at life insurance, that's a vehicle that we can give during lifetime or upon death. If we name a charity as the beneficiary, they get that upon our passing. So then that's not, you're going to get your estate will get a charitable deduction. We can instead look at giving that life insurance policy to a charity while we're living. If they become the owner of that policy, and we're still paying the premiums, if there are premiums that are still to be paid, you would get a charitable income tax deduction for that premium when it's paid, in the year that it's paid. The death benefits still go to charity, and then that life insurance is not part of your taxable estate. So again, many tax advantages available for that. Sometimes when we're looking at assets to give, we want to give something currently to get out of our estate, but we really don't want to give up some of that income. I had mentioned before about appreciated assets, those assets that had grown in value from what our basis was in those assets. Sometimes we have an asset that just isn't generating a lot of current income. It's got a lot of value, but it does not trigger a lot of either dividends or interest. So we might want to look to convert that into an asset that's going to provide us with more current income than what we're getting. But if we sold it, we'd have capital gains tax. An asset like that is a perfect asset to give to a charitable remainder trust. There are two types of charitable remainder trust. There's a charitable remainder uni trust, a charitable remainder annuity trust. A charitable remainder uni trust provides us with at least 5% of the value in that trust annually. So that amount can change, generally goes up if the asset is earning more than that. A charitable annuity trust gives us the same amount each year. If we have that highly appreciated asset and we put it into a charitable remainder trust, that asset can then be sold by the trustee of that charitable remainder trust, eliminating the capital gains tax. So now I'll use an example of an asset that's worth $1 million, but it's only giving me maybe a 1% to 2% return, only $10,000 or $20,000 a year income. If that $1 million asset is transferred to that charitable remainder uni trust or annuity trust, the trustee then sells that asset, no capital gains tax. So they've got $1 million to put to work. Then I determine when we're drafting that trust, what do I want the payout to be? Under my example, it was only going to be $10,000 or $20,000 on something that's earning 1 to 2%. Let's say I want an 8% return. Now I'm going to get $80,000 a year out on that. I got a charitable deduction for the value of the remainder interest. I have then quadrupled my income out to me, and I know that those assets are ultimately going to go to charity. So an appreciated asset is a great fit for that. The payout has to be at least 5% under the current federal law. And the amount of the deduction is based upon how long that trust is going to run. If I'm setting it up for myself, I can do it on my life expectancy. If I'm doing it for an individual, the term of years cannot exceed 20 years. So based upon the calculations, when you're meeting with your advisors, your accountant or your attorney can calculate what that amount of the charitable deduction would be. So we run through those calculations. Many times individuals end up whole, meaning that they've gotten a lot more out of this asset, so much that it's equal to what they gave away. And there's a very large amount ultimately going to charity. So a charitable remainder trust is an excellent fit for a lot of individuals. We also have what's called charitable lead trusts. It's kind of the switch of that, where it's the monies from that asset are going to charity for a period of years and then to someone else. A very good fit for that is we have a lot of individuals who have monies that they ultimately want to go to grandchildren, but also have a charity that they like to provide for. So with a charitable lead trust, they can say, okay, I've got this $1 million, or you can do it with $100,000, just do the math, that I want 5% to go to charity. I've been giving this amount to charity every year. So I want that to continue. Then at the end of 5, 10, 15, 20, whatever amount that is, then the trust would terminate and the assets in that then would go to children or grandchildren or whomever you want that to go to. So it's really just the flip around from what a charitable remainder trust is, which the assets go to charity at the end. The charitable lead trust, it goes to charity and then to someone else at the end of that. So when we're looking at charities and we're talking about what charities do we want to benefit, sometimes we have individual charities that we want those assets to go to. We may want to control how they use those within the terms. Sometimes we want those assets to continue to benefit our community. And so community foundations are an excellent vehicle to use because the monies can go there. You can continue to direct where those monies are going to go through a donor advised fund. You can then, within the limitations of the community foundation, indicate that you want children or some other individuals to direct where those distributions are going to go. That's an excellent fit if you don't have so much that you want to set up your own private foundation. A private foundation set up by an individual does have some costs associated with it, so you're never going to set one of those up for a couple $100,000. You must have much larger donor intent to set up a private foundation on that. But again, that's conversations to have with your planner to determine what's the very best way then to give. So giving to a community foundation allows for professional money management. It allows you to give to many different charities. You can identify what those are either within the donor advised agreement, or you can continue to advise them where you want it to go up through the rest of your lifetime, or even indicating somebody else. Another vehicle for gifting during lifetime is a charitable gift annuity. We talked about a charitable remainder trust. Generally, you want enough in that trust to warrant the expenses of having that trust. But if you've got a smaller amount that you want to go, 20, 30, 40,000, and you want to get an income stream back, if the charity that you want to give to offers charitable gift annuities, you give them the monies. So if people are looking at interest rates, we know interest rates aren't very exciting for individuals right now. They're very low, which is great on the borrowing side, not so great on the earning side. But based upon your age, if you give this money to a charity, then they will pay you back based upon your life expectancy. The older you are, the greater the rate of interest that you could receive. So if in your 80s, many times you can get a charitable gift annuity back for anywhere from 6 to 9% back. So you're really increasing your income stream while still giving to charity on that. And charities then put those monies in their general funds. They are obligated to pay you out for the rest of your lifetime, but they can hopefully put that money to work, getting more than what you might be getting on your certificate of deposit. If you have unique assets, sometimes we're in Iowa, so we got to talk about farmers. If you have a farmer who is going to look at retiring, most farmers are playing that tax game every year. They're really, really good at it. So what happens in that year that they're going to retire, all of a sudden, they've pushed all of their expenses into the previous year. Now they've got all this grain. They got this machinery and equipment. They've probably fully depreciated out or very close to it. Their grain, if they sell that, they've got to pay tax on that. So one alternative that we use a lot for retiring farmers is setting up that charitable remainder trust, again, where they transfer in maybe the livestock or the machinery and equipment, the grain. When that goes in, they only get a deduction for what their basis is on it. But the tax advantages are tremendous because they are then eliminating recapture depreciation. So if I've got a $300,000 combine that I've fully depreciated out, if I sell that on a farm sale for $200,000, I've got to claim all of that at ordinary income tax because I'm recapturing the depreciation on it. So many times we see those farmers with their list of assets, their machinery, their equipment, their grain that may be worth this, but then they're only seeing about 25 to 30% of it at best left at the end of the day. And they want those assets to start earning for them. So if they contribute that to a charitable remainder trust, they eliminate all that depreciation recapture, they eliminate all the capital gains, they eliminate all the ordinary income tax. They've got that money in that trust. They get a charitable deduction on their income tax return for what their basis was, but now they've got all those monies and to convert into an income stream for them that they would not have gotten near what they would have simply by realizing the net amount from the sale of those assets. So that's a great way for them to trigger an income. Even if they're not doing a charitable remainder trust, they can do that then also by gifting those assets directly to a charity if they want to avoid that income tax. So, and I said, and I'll let Mickey give me the high sign because I know I'm getting close to my 20 minutes here, but I did want to touch on credits too. We've talked about the tax deductions that we get for a donation, a tax deduction on our federal income tax return, a tax deduction on our Iowa income tax return, a deduction on our federal state tax return or Iowa income tax return, but also the state of Iowa provides us with credits. Credits are even more attractive than the charitable deduction that we get. The deduction is a deduction against our income. So that we're paying lower tax because our income is lower. A credit is a direct credit against the tax that we'd be paying. And Iowa provides some really beneficial credits out there. One is the Endow Iowa credit. It was started in 2004. It gives to an endowed fund at a community foundation. You get a 25% credit against the amount that's gifted. So if I gave $100,000, not only do I have that $100,000 income tax deduction, I've got a $25,000 credit against my state income tax. Those credits go fast, they're limited. For an individual, you can take $300,000 up to $300,000 annually. For a married couple, that's $600,000. Those credits that the state has, they're only so much. The credit cap, let's see, for this year is $6 million. Those have been used up already. And if you ask for those, you don't get them this year, you can get them on the list for next year. You can also carry it forward. So if you weren't able to take it, you can carry it forward. There's also the student tuition organization credits. That one gives you a 75% credit. The gift has to be to a qualifying organization, which would be primarily parochial schools, but you get a deduction then, not only for the charitable deduction on your income tax return, but you get then the credits that are available. That has $15 million in 2021 and $20 million available in 2022. So those credits combined with the income tax deduction, many times we find that individuals, the cost to them, the money out of pocket to give to a charity for that dollar may only be about 10%. So that allows them to give, and then we're getting the federal government and the state of Iowa, the Department of Revenue, joining in that gift by giving us credits back. So the end result, if we can identify that they've got charitable intent, the best assets on that, everybody wins. So I don't always talk about how much you want to give, just generally so that we can find out maybe we can give more to meet those goals, or we've got other different planning options that really give us a good opportunity to meet whatever the charitable intent is, and then also providing some flexibility for them. So I see I'm 2 minutes past my 20-minute allotment, Mickey. So I'll turn it back to you. I can't hear, Mickey, if you're talking.
Yes, I just got my computer on.
I see your lips moving, but I'm not hearing anything.
You can't hear?
I can now.
Okay, good. Thank you, Theresa. Theresa, looking at our nonprofit community and our Windwells and Waterloo community, sometimes we have people come into our organizations and they say, well, I'm going to put you in my will, or I'm going to put you in my estate plan. Or how do one find out if that before the person passes, if that actually happens?
Well, you can ask them to provide you with a copy. Many times people are very reluctant to do that. If you're partnering with them and you have a good relationship with them, they may be willing to do that, but those documents typically can always be changed. So, people are reluctant to give you a will. They change it 5 years later. They don't like old wills floating around. Beneficiary designations can be changed. I say the best way for the organization to know is to continue that relationship. If you've got that type of relationship, you want to be touching base with them every year or 2 or 3, just to make sure that the relationship is still there, and to have them confirm that, yes, you are still part of their estate plan.
As organizations, sometimes we have meetings and there are people in the audience that perhaps would like to give, but don't know how to give. And I know you, at the beginning, you talked about contacting your attorney or your financial planner or your accountant to move forward. How do we reach those people that we know they have a heart, for example, healthcare and whatever organization they want to give to? But how do we reach those people that don't know how to make this process work?
Well, by all of you that are either part of a charitable organization or work with one should have a good working knowledge. You don't have to know the intricacies, but even, like I put together a kind of a dialogue of a lot of what we talked to have some of that information available so that you can have those conversations with them and find out what the degree of their charitable intent is. If they're talking about $1,000 a year, $2,000 a year, that's as simple as them simply giving. But if they're talking about something more than that, where you want a plan that they can really benefit from the tax advantages on this, then you want to put them in touch with somebody that does this type of work. So I don't think there's anything wrong with asking them, who are you working with? A lot of us will give a lot of general information. We can't give advice unless they're a client, but we can give you general information about these. We work with a lot of their financial advisors. We've got good working relationships with most of the financial advisors in town, with the accountants. You really need a kind of a team approach on this, because many of the individuals haven't even put together their own financial statement to know what assets they have. So they don't know what those opportunities are. The first step always is for them to put together a good financial statement. Everybody should have a will or an estate plan. If you don't have one that you put together, the state's got one for you, and it's not necessarily has any tax advantages in it at all. So it really behooves all of us to have some plan in place, or at least to know what's going to happen with our assets and what the tax ramifications are. But again, just asking some of the questions, giving them some good information, and directing them back to somebody that can help.
Yes, I think the most important part of this or your presentation is that planning. You need to plan ahead, because so many of us don't plan, don't have a will, don't have the power of attorney and all of those things in place. And in the end, it could be devastating to a family.
Oh, it can be awful. Only about 22% of the population has estate plans.
Wow.
And if you look at 9/11, when our financial capital of the world got hit by those planes, when all of those conservatorships and states were set up, those are the individuals that are supposed to be really keyed in. Only about 25% of them had any estate plans. So it's more common not to have one than to have one, but you're far better served by having an estate plan. You know what's going to happen. And to your point, Mickey, it can be devastating to family members to find out what a disaster was left behind by lack of planning.
Exactly. Well, I'm going to open it up to our Winners on Waterloo community. Anybody have any question for Theresa? Hearing none, let me dive into another important factor that I think both the nonprofit and the profit community really need to work with their constituents is about insurances. Can you go into detail about what type, what kind, and is it important to have life insurance?
Life insurance?
Yes.
Well, it depends upon the purpose of the life insurance, because when you're buying life insurance, you generally will have a purpose in mind. Why am I buying life insurance? And it kind of, those reasons for it change through our lives. When, if I'm a single individual and I don't have to worry about anybody but myself, there really isn't a lot of need for that life insurance at all. But as soon as I get married or have a significant other, start having children, there are people that I may need to provide for, want to provide for. So I have life insurance on my life to maybe retire debt, to help educate children, to provide additional income for my surviving spouse. If you've got a good relationship with your life insurance agent, they should be walking you through these different stages. The easiest thing for life insurance when you're very young and you're trying to, geez, if something happens to me, my spouse is left with the house, this mortgage, kids to educate, is term insurance. It's inexpensive, and it's an absolute lifesaver for a lot of individuals if something happens to one or the other, because then you're not leaving another individual with extreme financial debt. And it's hard enough to lose a spouse, but then to have to change all of your plans because there's nothing there, and all of a sudden you're financially destitute, is a terrible situation. As then your children get grown, your mortgage is paid. I mean, that insurance need is no longer there. And that's why term insurance fits so well, is because it's there for a term. We're insuring a term of our life that we want to cover. That's why it's cheaper. If you have permanent insurance, again, there needs to be a reason for that. Is it to provide cash then for payment to individuals, to provide for charity? Why do I want that money down the road? There are a lot of different insurance products, some that we pay in premiums for, and I don't sell insurance here, but that we pay premiums for that build up a cash value. There was a lot greater need for life insurance upon death for payment of estate taxes and Iowa inheritance taxes when our tax laws were different than what they are now. When I got into this game, the exemption amount for federal estate tax was only $600,000. Today it's 11.7 million. A lot of people don't get beyond that figure, even though they're talking about cutting that amount in half. There's an awful lot of people that don't have estates that rise to the level that we need insurance to pay taxes. There are some that we want insurance to be able to provide for retirement of debt, or sometimes we have that insurance because we have an asset like a family farm or family business that we want to go to one or two beneficiaries, but we also want to provide something equal to other ones. So it's like all of our assets, and it is an asset that you need to have it reviewed every few years to make sure that it's still fulfilling the need that was there, or if that need still exists.
Thank you. And I think that's critical for especially young people to understand the difference between whole life and term. And to have that information will help them budget their lifestyle. My next question is that you touched on foundation. Can you inform the audience the difference between a private foundation and a community foundation?
A community foundation, you get different tax deductions. A community foundation is one where you determine what the scope and the breadth of the giving of that community foundation is. You give the money into that community foundation. The money belongs to the community foundation. If you haven't put any restrictions on it, they will distribute it out according to what they feel that it should go to based upon their guidelines. A private foundation, there are two types of private foundations. One that is set up as a corporation, one that's set up as a trust. Most individuals, if they're setting up a private foundation during their lifetime, will set it up as a corporation. They then put monies into that private foundation. It has to, there's costs associated because you have to then file a Form 1023 to get your tax exempt status. You have to file a 990 PF each year, which is the return that tells the IRS what you're doing, that you're following all the guidelines. You put money into that private foundation, you're going to get the tax deduction with limitations for putting that money into the foundation. Then the board, the corporate board, will determine where that money goes each year. Generally, it's family. Generally, it's a family foundation when it's set up during lifetime. You almost always, if you want that foundation to continue after you're gone, to have it flow through to a private foundation that's a trust, because within that trust, you can set up what your guidelines are and they can't be changed. When you have a private foundation that's a corporation, the corporation can continually change, the board can, what the charitable intent is, where are those monies going to go. When it's within a trust, it can't be changed. There's no shortage of charitable organizations out there. And if you watch the listings that the IRS provides, I mean, they're growing exponentially. If there's money out there to get, there's a lot of organizations that are just going to get set up. But there's a lot of them that are completely different in their focus, completely different where they're located at geographically, who they give to. So while you can control your giving or your family's giving while you're living, if you have very set ideas what you want those monies to be used for, and you have significant funds, then you may want a trust that's set up after you're gone. If you had it set up during lifetime, those assets can move into that. If you have assets that you want to fund that trust upon your death, those assets go into it. You can have a grant-making committee of your choosing that determines where those monies go, but within guidelines that you've established that can't be changed.
Thank you. You also spoke about the first step is first having an intent and then seeking out help. How would one go about seeking out getting a financial planner or an attorney or an accountant to help them and to help their organization move forward?
If they have assets, significant assets for giving, I would hope they already have some relationship on that, typically at least with an accountant who they can refer back to unless they're doing their own income tax returns. But most individuals have at least one of those three, an investment advisor or an accountant or an attorney. You get the best result when your advisors are working as a team because we all bring in different perspectives, different knowledge base. I'm not going to tell you that I know every single in and out on an individual's income tax return, but from the estate tax side of it, the income tax benefit side of giving, I've got that piece covered. But their accountant also knows everything that's going on with them from a day-to-day basis, like with a farmer or business owner, what their annual tax ramifications are. I don't sell investments. I don't sell life insurance, but your investment advisor or your insurance agent would have the knowledge on those assets. So when we start talking about significant giving, generally you're pulling that team together to help them determine what. If it's large amounts, you really do want that whole team approach. If it's smaller amounts, many times they're just talking to their accountant saying, gee, I want to give $5,000 or $10,000 this year. Where's the best place for it to come from? Or if it's part of their estate planning and they're reviewing that every couple of years, we have that conversation, or they can have that conversation with their advisor. Any one of those three should be able to help them with smaller annual giving. Bigger gifting, you're better off with kind of that team approach.
Excellent. We have a question that says, can burial expenses be designated from retirement funds?
I'm sorry, I did not hear that.
Okay, the question was, can burial expenses be designated for or from retirement funds?
Well, retirement funds pass through a beneficiary designation. So that's not the best. It's a very poor way to do that. So if I'm saying I want $10,000 from my IRA to go to my burial funds, you're going to be, burial funds are a deduction, but somebody still has to claim the income. So you can't go to your funeral home with that because they're not going to pay income tax on it. And you still have that obligation. So primarily the answer to that would be no. We can structure it so that we know where it's going to go to. A lot of people say, well, I'm going to give that to my oldest kid so they'll pay the funeral. Well, there's no obligation for them to do that. They may come back, and I've heard this in my 35 years. I knew mom loved me best. That's why I got that money. And everybody else has to pay the funeral. The best way to do that is to designate those funds to go, whether it's to your trust or your estate that's going to be obligated to pay that. Generally, we don't like life insurance funds going that way, but if that's the only place for the monies to come from to bury you, then it's probably going to go to your estate, not to an individual, certainly not directly to the funeral home, because somebody still has to pay the tax on it. So if you had $10,000 go to the funeral home and it's paying your bills, then your beneficiaries are going to pay the tax on that $10,000 that they never saw. So bad outcome.
Now I'm going to open it back up to the audience if they have any questions.
There's one more thing about the estimated cost for a young couple to get a will prepared.
Okay. There's another question before I open it back up. It's about, I don't see it. One moment. I'm on a different person's computer. I don't see it. You want to ask the question? I'll have Aaron ask the question.
Sorry about that. So one of the questions here is, how much is an estimated cost for a young couple to get a will prepared?
It depends. I mean, it can be anywhere from $250 to $500. That's probably generally how much it would be around here. I can tell you if they're going out of state or in the big cities, you could probably add a couple zeros to that. I've seen just horrendous costs with that. But if you're looking at wills for a young couple that leave things back and forth to each other, also provide a financial power of attorney, medical power of attorney, living will, and if that traditional will where they want things going back and forth to each other, we're generally recommending that they own everything joint with rights of survivorship if that's what they want to have happen. If they have kids, then we're generally talking about a trust within that will that provides for those children. That will should designate who's going to raise your children if you're not there to do that. The trust will designate, what the monies are to be used for, who's going to be trustee and what ages. Generally, I've been charging $250 to $400 depending upon the individuals. When they call in, we send them a estate planning checklist. The more homework they can do on their own saves us time. You save us time because we generally are billing for our time and expertise. You're going to save money. Sometimes I find that they come in, they haven't even talked to each other, and it's no fun for 45 minutes to watch them go back and forth about, I'm not having her raise my kid. I'm not having his raise my kids. So the more work they can do ahead of time to have those questions answered, they save time. but that's just kind of a rough cost. Best thing to do is just call and ask. Nobody seems to mind asking me what it's going to cost. So they, have an attorney relationship, just ask. If they don't, ask around, find somebody who does that type of work. I mean, you don't want your attorney learning on you. You're not going to go, just like you don't go to a foot doctor for a headache. You're not going to go to a criminal attorney to get your will done.
Excellent. Any additional questions from the audience?
I have a question. Theresa, can an IRA rollover go into donor advised fund?
Yes, it can.
Okay.
So if you had an IRA and you said, I want to do a charitable rollover, you can have that go directly to if it's a donor advised fund, to that community foundation. It goes in there. You don't claim any income tax on it, and you would still be eligible for the credits if you're an Iowa resident. Sorry, Mindy.
Okay. Thank you.
Mm-hmm.
Any other questions? I think it's estate planning and gift giving is a very, very important part of our lives. And I think it's something that we often put on the back burner until the 11th hour. And sometimes it's too late. So it's great that Theresa could talk to us about estate planning, how to give, different ways of giving, and finding that purpose on what you want to give to. I think it's going to be critical as we move forward. And we're living longer, so knowing Theresa talked about giving with your life expectancy and plan in place and thinking about that. But we need to also think now that because of modern medicine and all the other advances in medicine, we're living longer. So Theresa, how would one determine if they want to give with the payout expectancy based on life?
Well, if you're talking about a trust that pays out for your life expectancy, you're going to generally run those numbers, but the only way it would stop before you stop is if it's not earning enough to keep up with that. That's very rare that would happen. I've only had, in the 7 years I've been doing that, I've only had that happen one time, but they had a huge payout percentage. They had a 14% payout percentage, and the market just could not keep up with that. So generally, if it's for life expectancy, and really the best way to determine life expectancy is to take a look at your own. So sorry.
Not a problem.
Is to look at your own family history on that. Take a look at your own health situation. But again, we're all living longer. There's opportunities to live longer. But there's none of us have a guarantee we're going to be here tomorrow. We all try and plan. And the only other thing that plays into, if you're afraid about living your money, you're probably not looking to give to charity during your lifetime. The only way would be if you can take an asset that you can convert into an asset that's going to give you more current income.
Excellent. Any more questions for Theresa? Then Theresa, I would like to say thank you once again for your presentation. And you hit on a very key and very important topic, is giving. We all have the ability to do it. Some of us just don't know how or how to even get started. And you gave us that information. So we're grateful for that. I would like to let the audience know December 2nd is our next window on Waterloo, and that's going to be Jared. He's in charge of the Allen College, and he's going to give us an overview on what's happening in the medical career and college and the shortage of medical personnel. Then on January 5th, we have our next presentation. But I want to also let our audience know that December is my last month of being the president of the foundation. I will be around for another year, but we're going to try another method of hosting, and we're going to have Aaron and a few of our board, the president-elect Lori Johnson, going to co-host windows on Waterloo in the future. So in January, you will see another face at the presenting and opening the windows on Waterloo. So I want to say to all of you guys, thank you for the opportunity for us to be able to offer this type of programming to our nonprofits. And thank you to Theresa, and thank you for the great job of covering that. And if you have any questions, please do not hesitate to reach out. And on that note, everybody have a great day. Thank you, Theresa.